here. I'm Professor Indrabhusegara. One of the learning goals in this workshop is for us to understand the composition of shareholders' equity. There are three components in the shareholders' equity: share capital, reserves, and retained earnings. Share capital has one or several classes of shares. In a company, publicly held company, there can be one or several classes of shares. The most common is ordinary shares. They are also called common stock. Ordinary shares have voting rights, and they also receive dividends based on the number of ordinary shares held. There's another class of shares called preference shares, because they take preferential right for the dividend payments. So the dividend payments for the preference shareholders should be made before paying ordinary shareholders. And the dividends could be cumulative dividends or non-cumulative dividends. What it means is that for the preference shareholders, the dividends were not paid in a given year. It gets accumulated into the next year until it has been settled. There can be also a third class of shares, non-voting shares, where shares have been issued, but they have no voting rights. Compared to ordinary shares, where shares have voting rights, but non-voting shares do not have voting rights. Preference shares also do not have voting rights, and they take preference in the dividend payment. Then the second class are the reserves. Reserves are money set aside for various future purposes. It could be for future expansion of the business. Examples of that is the revaluation surplus, that is the asset value increases in the marketplace that is being recognized as a revaluation surplus, increase in money, general reserve, and then also forfeited share reserve. That's the second class, second component in shareholders' equity. The third component is retained earnings, that is the accumulated earnings or the losses, accumulated profits or the losses. So the share capital, reserve, and retained earnings belongs to shareholders. One day it has to be given to the shareholders. But because a company is an ongoing entity, that generally does not take place. But if the company is to be closed down, then these have to be given away to the shareholders.